So I've spent a lot of time clearing cobwebs before getting to this particular point of going through the financial instability hypothesis in some detail. And the essential point Minsky said was, you need a theory which gives us Great Depressions as a possible outcome, not the only, but a possible one. And what he built, he tried to do a mathematical model of it to some extent in his PhD thesis before he actually got the whole hypothesis put together, but largely he never got past the verbal model. But what verbal model had what neoclassical models lack, and that's both history and time. You're saying if you're in historical time, then there's been some debt-induced recession in the recent past. The best one for us to choose would be the 1990s recession, as Australia called it the recession we had to have, Paul Keating's recession. And in the aftermath of that, if you recovered from the crisis, you're not continuing a downward slump like America is right now, but you recovered from the slight crisis, everybody's scarred by it, and both borrowers and lenders are conservative about the amount of risk they'll take on. So a lot of neoclassicals try to interpret Minsky in terms of asymmetric information, where the lenders know something, the borrowers know more, and that's why the crisis occurs. In Minsky's thesis, they both have the same views about the future, the same expectations. Because they're both conservative, both lenders and borrowers, only conservatively estimated projects are put forward, and because the economy's recovered, most of those projects end up succeeding. And what that does, of course, is make borrowers and lenders both think, oh, if we've been taken out more debt, had a more levered position, we would have made more money. So they start to reduce the fear they have about the future, reduce the risk premiums they put on projects, accept a higher level of debt to equity, and they start revaluing assets, regarding assets as undervalued. And what you've got there is a period of tranquil growth causes expectations to rise. And this is probably Minsky's most important phrase. It's stability or tranquility in a world with a cyclical past and capitalist financial institutions is destabilising. But because equilibrium is not the norm at all in a capitalist economy, nor should it be, that means that a period of tranquil growth actually leads to rising expectations. And those rising expectations then set off a whole range of reactions. So for a while you get self-fulfilling expectations because there's a decline in risk aversion, there's more investment. Because there's more investment, the economy grows faster, so it's like a virtuous positive feedback. But you also get rising asset prices, and that makes it possible to speculate on rising assets with borrowed money and make more money. And of course you get an endogenous expansion in the money supply, as I've explained ad nauseum here. And that enables riskier investments to be undertaken, and also more asset speculation, which is the most dangerous part. And ultimately you get the emergence of what Minsky calls Ponzi financiers after Charles Ponzi. Now the essential thing about a Ponzi investor is somebody whose cash flow is less than their debt servicing costs. The classic instances in Australia were Alan Bond and Christopher Skase. Now, Alan Bond, as we all know, went bankrupt selling beer to Queenslanders. Now how the hell do you do that? You borrow too much money to buy the brewery, that's how. So fundamentally you're getting less cash flow from selling the beer to the Queenslanders than you've got to pay to the banks to service your debt, and therefore of course you've got an insatiable desire for more debt, because without more debt you can't roll over your current position. The classic one for Christopher Skase, an old flatmate of mine, put it beautifully at the time. Skase put in a $3 billion takeover bid for MGM, and Kerkorian, the American businessman who ran the major shareholder, investigated Skase's finances and really basically said, this guy's a Ponzi merchant, don't touch his offer with a barge pole. So the $3 billion bid was turned down, and 1 week later Skase went bankrupt because he couldn't pay a $12 million loan instalment. As my flatmate said, it's a bit like making an offer to buy a house and then going bankrupt a week later because you can't pay the electricity bill. Now the reason that happened was because Skase, if he got the $3 billion bid accepted, he would have borrowed $3.5 billion, used the extra money to pay off his existing debt that he was accumulating by not having enough cash flow to pay his current debts, and rolled on for a couple of more years until MGM would have gone down with him. Now, they also, of course, can profit from selling assets on a rising market, so they're vulnerable. They both need rising debt and rising asset prices. And given the fact that they both have to have the debt to continue to rolling over their current debt, and they also expect asset prices to rise by huge amounts on an annual basis, their demand for finance really can't be cut off by high interest rates. if you expect asset prices to rise by 25 to 50% in a year, and bear in mind the Australian stock market rose 80% between January 1 and October 20 or so of 1987, you can't cut that off with an interest rate of 80% because on no planet can you put the rates that high when inflation is running at anything of the usual order below 10%. So you simply can't cut off their demand with high nominal interest rates. And of course they've got to get borrowed money, otherwise they go bankrupt. Again, my favourite illustration with Christopher Skase, he got his money from FIA. Anybody here remember what FIA was? No, a couple, okay. FIA, Rodney Adler's father, Larry Adler, set up FIA as a finance insurance, I think it's called Finance and Insurance of Australia. And the idea was it would provide entrepreneurial funds. And of course, Skase would end up knocking on their doors quite regularly. And Rodney and Larry, when Larry was still alive, used to play a game of alternating who would see Skase and putting up the rate of interest by 1% on every meeting to see whether they'd ever reach his point of tolerance and break it. And he always just said, okay. As soon as they said, this is the price, yes. He finally agreed to 25% interest rates, back when the rate of inflation was running at about 15%. He desperately needed the money. Now, ultimately, all that borrowing by Ponzi's is simply adding debt into unprofitable businesses. So you're loading up the debt load on the economy. They're necessarily losing ventures. So they don't add to the capacity to pay the debt, while they add to the amount of debt outstanding. They hope to distribute it to other people through the economy, but fundamentally you've got a rising debt level without an increase in the capacity to fund that. So you've got more and more unprofitable businesses turning up, permeating the whole system, masked by this rise in asset prices. And also, if you have rising interest rates, then projects which are conservatively funded may end up actually being speculative. In other words, they have got a negative cash flow in early years, maybe a positive later. Now, some firms in that situation can decide to sell their assets because they think, well, there's a broad market for assets out there, let's liquidate a few assets and get some money for them. And that is enough to prick the market in assets. Asset markets are much, much narrower than our obsession with them implies they are. A small change in the supply of assets flowing on can end an asset price bubble. So that trend for rising assets either falters or goes into reverse, and the first ones to fold are the Ponzi's. My favourite Australian example then is another merchant from the 1980s period, Laurie Connell. Laurie Connell was known as Last Resort Laurie in West Australia, and the then Premier of West Australia, Brian Burke, once remarked that he'd hate to stand between Laurie Connell and a bucket of money. Well, Laurie Connell went bankrupt the day after the 87 stock market crash, literally the day after. And he was rescued by a bunch of private lenders, private entrepreneurs, organised by Alan Bond, in the basis, same sort of Lehman Brothers basis, if Laurie goes down, we all go down, we've got to throw money in. They kept him going for a short while until he went bankrupt and spent his retirement at Her Majesty's Service in Western Australia. Of course, one person who didn't put money up was the guy who organised it, Alan Bond. Anyway, so the Ponzi's go bankrupt, they can't sell assets for a profit, the debt servicing exceeds their cash flows, asset prices collapse, the debt to equity ratios can rise for a short while because equity prices collapse while debt remains the same. That expansion of the money supply stops, investment evaporates, economic growth slows, and you're back in a debt-induced recession. This is an essential nature of a dynamic model. You get back to where you started. Okay? You've got a causal loop leading you all the way through. Now, what about in the aftermath of that? Well, if you have low inflation, then the debts can't be repaid. And bankruptcies can affect even businesses that weren't speculative. If you've got a viable business lending to a Ponzi merchant or providing goods to a Ponzi merchant on credit, the Ponzi folds or your cash flow drops, you can be put out of business even if you have been quite responsible, and you get a depression. If you have high inflation, then the rising cash flows can service the debt. And the inflation therefore reduces the debt burden, and that gives you stagflation. So Minsky had a Keynesian style explanation for the stagflationary period, despite it's almost proof that Milton Friedman was wrong. He actually used the stagflation period to bash people basing their ideas on Keynes. He rightly bashed the orthodox mob, who Joan Robinson once eloquently described as bastard Keynesians, God knows what she'd describe this current mob as. But this is a Keynesian explanation for a period of high inflation and low growth. The other factor which can turn things around is big government. And Minsky really saw government spending in a cash flow sense, that the spending that the government did into the economy gave firms a cash flow they wouldn't otherwise have, would let them repay their debts, so the cycle could renew once the debt levels were reduced. And you get this, according to Minsky, could give you cycles, but he didn't define stability as the absence of cycles. Okay? To Minsky, this stability was the absence of a breakdown. So he saw the government as providing funding, which would mean you got cyclical behaviour rather than getting a total breakdown. So, how do you model all that? Well, Minsky's attempt to use Hicks's trade cycle model was flawed right from the outset, so no wonder that didn't get anywhere. But it's possible to model this on the Goodwin model that I've been through with you to some extent in previous lectures. I'll go through it in more detail here. And Goodwin wrote this model as a way of putting into mathematical form the verbal model that Marx actually came up with in chapter 25 of volume 1 of Capital. And this was quite out of, given that overall in volume 1 of Capital, Marx assumed that workers got paid what he called the value of labour power. But in chapter 25 he had a verbal model of cycles where wages change throughout the cycle. So brace yourself for some Marx speak, written in typical Marx's typical language, but here's a description of a cyclical process between income distribution and employment in a capitalist economy. So a rise in the price of labour because of accumulation of capital. Means the rate of accumulation slows. But as it does, unemployment starts to rise. Rising unemployment pushes wages down. And you're back where you started again. So let's put that in more mathematical form. High wages will give you low investment, meaning low growth. So you get rising unemployment, which means falling wage demands, leading to increased profit share, and therefore rising investment, which will give you high growth, leading back to high employment, which will give you high wages. Okay? That's basically the verbal loop there, but we can actually put that in mathematical form. And Goodwin saw similarities with the predator-prey models that he'd recently become acquainted with. And I'll put this up very rapidly, I'll talk about it beforehand. One of the ironies of this, by the way, is that when you formally transfer Goodwin's model, master model into mathematical form, it's similar to predator-prey in structure, and the irony is the predators are the workers and the capitalists are the prey. So the rate of growth of the prey, as you know, in the fish models I've shown you so far, depend positively on food supply and negatively on interactions with the predator, and vice versa for the rate of growth of the predators. But formally speaking, as I've said, it's not what Marxists would expect to come out of a model by Marx as to who the predator and who's the prey. Well, let's build it. I'll go through the maths first of all and then show you in a flowchart format. So the causal chain is that the level of capital stock determines the level of output, rate of flow. Output then determines the level of employment. The level of employment determines wages through a wage change function. The level of wages determines profits. Profits determine investment, and investment determines the capital stock. So you're back where you started again. Let's put that in an equation. So the basic relationship that empirically applies in capitalism is some rough correspondence between the level of output and the level of capital stock, however you measure it, the accelerator relationship. These normally got a value between 2 and 4 for most economies, fairly stable, and 3 tends to be the usual value people use. So the level of output is about 1/3 the value of the capital stock. Level of output is then that level of employment is that level of output divided by labour productivity. Wages are then set by workers' response to the level of unemployment. This is a Phillips curve relationship, and I'll go into more detail about that later. Profit is output minus wages. Investment is then a function of what profit is, and that determines the capital stock because the rate of change of capital is investment minus depreciation. And you get rate of change terms in two places, a rate of change of wages and a rate of change of the capital stock. And overall the whole causal chain is linked around. So now I'll show you that as a flow chart. That's the basic mathematics behind the Goodwin model. Here's doing the same thing as the flow chart. So capital determines output by an accelerator relationship. Feed capital in, divide by the accelerator, you get the level of output. Output determines employment via labour productivity. So I take the level of output divided by A for labour productivity, which I've set at just a value of 1 in this illustration, and I get how many workers you need to employ. Divide workers by the population, which I set at 100 here, and you get the employment rate. That then determines the rate of change of wages via a Phillips curve. What I'm using in this simple illustration here is a linear Phillips curve, like a Nehru, so to speak, of 4% unemployment, at which level there's no change in wages. If unemployment falls to 3%, wages rise by 10%. Integrate the rate of change of wages to get the actual wage level once you add it to the initial wage. Multiply that by labour, which of course is another variable in the system. That's very important. That gives you the wage bill. Subtract that from output, you get the level of profits, and then in this simple model all profits are invested, so that's the rate of change of the capital stock, and that's what closes the whole loop. You integrate the rate of the investment, add it to the current initial capital stock, you get the new existing capital stock, you get a cycle. Now what that gives you is cyclical behaviour, which is what Marx foresaw back in 1867, even before he could put it in mathematical form. He saw continuous cycles, which is an incredible level of wisdom. Because when you put it together, you get cyclical behaviour. You don't get equilibrium. So to illustrate that, and I have actually purchased the next copy of this, but I still haven't got the bloody licence from UWS, so I hope it turns up in a while. That's just to illustrate this is not just a drawing, this is a systems engineering diagram. That's exactly the model I've shown you there a moment ago. And if I now run this model, let's check and see what running in real time. Right, okay. You simulate it and you get cycles in employment and worker share of output. Out of phase cycles, and they go on indefinitely in the model. The same sort of cycles I showed you for fish and sharks in the predator-prey models. And they're caused by an essential non-linearity in the system. There's no non-linearity in the model of linear relationship for a worker's response to wage, to the unemployment rate in the system. I've got linear investment by capitalists. The cycles come because I'm multiplying two variables in the system together, wages times employment, that little block there. That's an essential non-linearity. So one thing which a lot of people who don't know non-linear work think is that people put non-linearities to get cycles. No, what the non-linearities do is they constrain the cycles to realistic values. Because you'll see in this model, I get wages being basically 1.2 times GDP. Of course they don't reach that level, but it's the non-linearities in the reactions of workers and so on that restrain it below that level. When you have linearities, you get absurd results, including, for example, when profit is negative, you get capitalists destroying factories. No, they don't. So non-linearities make your behavioural outcomes more realistic. Now I'll do it again in stages. So I'm going to build the flowchart model. I've shown you this in the previous model, but I'm going to include growth in population and technology now and a non-linear Phillips curve. And I'll go through rates of changes first of all. So I've got a relationship now between investment and capital where the level of investment depends upon the rate of profit. And of course investment determines the rate of change of capital stock. What you do first of all is you integrate that with respect to time. So you're saying the capital stock is the integral of investment also added onto the initial level of capital. So I'm going to say, let's say there's 300 units of capital. You integrate the flow of investment, add that to the initial capital stock, you get the new capital stock. And that's the process by which you get a growing level of capital in the economy. Now I then have to divide that capital stock by the accelerator to get the level of output. So that's what I've shown you in the previous slide. Now what I'm doing is dividing them by the accelerator to get the level of output. So I'm going to build up a flow chart and bring it back to its beginning again. Now I divide output by labour productivity to get what the employment level is, and then divide that by population to get the actual employment rate. So I've got to now explain productivity growth and population growth. Now I'm assuming a constant rate of growth of population and productivity, so that means exponential growth over time. So I'm saying if productivity grows at 3% per annum, then you integrate this 3% rate of growth, add it to the initial productivity, number of goods per worker, and you get the existing level of productivity. So if you start at 1 worker per unit of output back in the year 0, by the time you get 100 years on, you'll get 3 units of output per worker. And the same thing for population, with that growing at 2% in this little illustration there. So if you start with 100 workers in year 0, population grows at 2%. By year 100, you'll have 800 workers. Then I now divide output by labour productivity to work out how many workers are needed. So here's the productivity block, which I put in here. There's a divide by block. I've now got the level of employment, and I've now got to divide that by population to get the rate of employment. So there's the population block, and notice I've got to wire down to the bottom here to make it readable. So it's getting pretty messy, but you can clean it up using what are called compound blocks. And once I do that and I put the things together, that's the sort of relationship I get. Capital to output, divide by productivity, you get employment. By population, you've got the employment rate. So you can tidy these models up and make them much easier to read. But I've now got to do probably the most complicated block of the lot, and that's the relationship between employment and the rate of change of wages. Now it's a Phillips curve, and I've been through Phillips in previous lectures, but what he was doing in doing the research for the Phillips curve was trying to middle the bottom model just like the one I'm building now. And to fit his data, I'm using a generalised exponential function rather than the log function he used. The exponential works better. That's the exponential function I use. If you feed in a minimum rate of change, which I've got as 4%, so prices will fall by wages will fall by 4%. That's the fastest rate of decline they'll go by. Feed in an xy coordinate that curve passes through. So what I've got here is to say that at 96% employment or 4% unemployment, wages remain constant. And the slope at that point I've got is 2, which means at that point any slight increase in employment causes twice a larger change in the level of change of wages. And you get the curve you can see over there. So again, I think I explained this one a bit last week. In a flowchart it looks like this. I didn't get the usual groans I get. Okay. I think the equation is actually easier to read from that particular block, but it does exactly the same thing. But I now feed in employment rate at one end as my x, and I get wage change out the other. And I've made a compound block for that as well. So now I've got capital divided by the accelerator becomes output, divided by productivity becomes employment, divided by population becomes the employment rate. Feed that into this block and I get the rate of change of money wages. Sorry, I've got real wages at the other side. So I multiply that by the wage to get the rate of wage, the level of wages. Well, there's the Phillips curve. So they're saying wages, the actual level of wages now are the integral of wages multiplied by the Phillips curve relationship. It's that next block. So the whole system now looks like this. I'm slowly getting my way back to the beginning again. And I've now got to work out profit. Well, profit is output minus wages. And wages is the wage rate times employment. So I've now got this little expression here. I bring output down from the top through this little wire here. I subtract wages from it, and I've got the level of profit. And since capitalists invest all their profits, I simply just connect that back up to the capital relationship, and I've closed the whole model. That's what goes on there. And if you add some graphs, you get cycles and the employment rate coming out of it. I'll just quickly show you back over this model. I've done here the linear one to show what I mean by compound blocks, by the way. There I've got capital divided by the accelerator becomes output. If I rubber bound those, click on create compound and call it capital, then I compress all that complexity into one unit. That's the sort of function I'm talking about there. So we get cycles in this model. Notice the cycles, as I'm illustrating here, have they don't get the same level of wages as in the previous level. So the nonlinear relationship constrains the extent to which the model says wages will rise to a more realistic level. Let's just simulate that. I'll make sure it runs in real time so it's not too fast. Just make it say 3 times usual speed. You simulate it and you get cycles in wages, share and employment. Plot the two against each other, you get this complete loop, and the level of growth, as Goodwin called it, it's a cyclical growth model. You get both cycles and growth coming out of it, if they're integrated together. And they'll go on indefinitely with the model as it stands. So that's the beginnings of a realistic model of capitalism. But we need to add one more component to it, and that's debt. And therefore what you need to have is capitalists wanting to invest more than they earn at some rates of profit, otherwise they won't borrow. And this is what, again, good research by neoclassicals, and they actually restrict themselves to empirical research, they're not too bad sometimes. This is Fama and French. Investment increases debt and higher earnings tend to reduce debt. That is fundamentally saying the rate of change of debt is investment minus profits. And they had a couple of research papers where they discovered that. Fortunately, they've finally published one of these, but not the other. I've got the reference actually in Debunking Economics. So a nonlinear function captures that. I used exactly the same exponential form as I did for the workers' side of things. So the basic argument is that investment will exceed profits at a high rate of profit, be less than profit at a low rate of profit. And what I'm doing here is, of course, the reverse of Friedman's argument about more realism means a less good model. The more general you make it, the better the model gets to be. And you don't need any stupid assumptions to hang on to equilibrium, as neoclassicals do. So as the generality grows, you don't fall over your own bootstraps by hanging on to this nonsense assumption of equilibrium. I'll use the same exponential form. So investment equals profit at 3%. It's greater than profit at that level, so firms have to borrow. It's less than that 3%, so they try to repay debt. And I've then got a slope of change of 2 at the point where investment equals profits. And minus 1 is the minimum value, just as a simple way of simulating depreciation. So that's the expression there. These are a couple more controls I can put into the model, by the way, bringing up meters rather than just a graph. Now, it actually makes no substantive difference to the model before I bring in debt, to bring in nonlinear behaviour by firms. You still get the same closed cycle, and you get a more extreme up and down in the system. Notice I'll come back to this model here. I think I've got this down the bottom here. Yeah, that's the sort of rate of growth pattern you get out of the model. You get a long boom and a sharp slump. And that's pretty much the empirical shape of the trade cycle. So even at this simple level, you're getting something realistic about the dynamics of the system compared to neoclassical modelling. But of course, to complete the whole thing, I've got to bring in the fact that banks actually have to borrow money to finance that. And I just use the simple relationship that, again, Fama and French confirm, the rate of change of debt is investment minus profits. And profits are now net of interest on outstanding debt as well as wage payments. So you've got investment increasing debt, profit decreasing it. Debt will rise if investment exceeds profits, and you've also got the compounding because you're charging the rate of interest on the outstanding debt. So that's what that particular expression there does. Investment minus profits is the rate of change of debt. Added to initial debt, you've got the new level of debt. Multiplied by the rate of interest, you've got the amount of interest payments subtracted from profit. So profit is now net of interest payments and wages, and I've compressed all that into that one box, all this into that one box down here. And the whole model finally looks like that. Now in the first simulation, which I'll show you in a moment, debt becomes negative. What that really corresponds to is capitalists accumulating a positive bank balance, which in this case is roughly equal to 100% of GDP. And in that sense, this equilibrium is stable the way Fisher talked about an equilibrium, because if you're close to it, you actually converge to it. So I'll run that model. Where to go to? Run the model. Make sure the run it in real time, but not 2. Let's make it say 5 times real time. Make the graphs a bit bigger. Got a bit of space to play with here, so let's play with it. One reason I like having large monitors. And you can see the cycles in the debt ratio here, and heading negative through a series of cycles. And in terms of what's happening to employment and labour's share of output, they're cycling towards an equilibrium. So the system is stable. It's heading towards its equilibrium in the centre there. And it'll converge there and stay there, but let it keep on running. But Fisher also said that, as well as saying you can say that variables, if they're will within wide limits, tend towards equilibrium, he also said it's the kind that is so delicately poised that after a departure from it too far, instability ensues. And that's what actually happens. If you start that model further away from the equilibrium than I did in that simulation, rather than cycling down, it actually cycles away. And to simulate that, this is exactly the same models with a different value of population to give me a different initial level of where's it got to? A different initial level of unemployment. And I'll bring up the debt to output ratio to show you that one most clearly. Now you get cycles in the level of debt which are ratcheting up over time. So each boom leads to a slump. Each slump gives you a recovery. Debt levels fall, but not quite to the bottom. Notice there's some curious dynamics there as well. As that little pimple moves further and further across, the stability of the system actually changes. Formally speaking, this model has no equilibrium. When you start too far away from the equilibrium, it only has an equilibrium if you start close to it. It's called the inverse tangent route to chaos. And ultimately you get a level of debt that overwhelms the economy, and it's good night Josephine. Employment brings everything down. That's what's actually happening. Employment collapses. So, again, one thing I'm not modelling here is bankruptcy, which is what actually stops that process in a capitalist economy, the abolition of debt. So what we've got happening there is exactly the same model giving you two very different outcomes. And that's because a non-linear model can be locally stable, where the linear component of the model dominates, but globally unstable. And that's a bit like having a number and squaring it. If you're starting with a number below 1, so let's say a is 0.9, then squaring it gives you 0.81, which is less than 0.9. You keep on doing it, a to the n will ultimately converge to 0. But if you're using 1.1 instead, then a squared is 1.21. And as you keep on doing it, you get a bigger and bigger number and you go to infinity. So fundamentally in these models, if you start too far from equilibrium, you'll suffer a debt-induced collapse. And how do you get far from equilibrium? Well, Minsky's argument again comes back about euphoric expectations. There's something in the behaviour of the system that leads people to getting euphoric and taking on more money during boom, having to repay it during a slump, and giving you that ratcheting up process leading to a final collapse. So you can do a fair bit of Minsky just in a simple model like this, but there's lots you can't capture. There are limits to what you can do with mathematical modelling. I don't, for example, have evolutionary change in the system, such as the government, for example, becoming more relaxed about the level of unemployment. Or I don't have systemic change being feasible either. So there's some things you can't do, but you can cover a huge part of the actual dynamics of the system in a model like this. And by not doing it, by sticking with verbal modelling or equilibrium modelling, we don't even get to see this phenomena in the first place. So you get a better handle on reality by thinking in this dynamic way than you do with either verbal logic or with straight static mathematics, which is by far the most misleading way to think about any system. Now, the next thing is, what does government do? I'll bring in prices next week. Well, Minsky's view is government gives firms cash flow they wouldn't otherwise have during a slump, which means they can get out of the crisis with cash flow that wouldn't be there were the government not paying the dole to workers. And it also restrains the booms by cutting off their profits with a high level of tax during a boom. So just to bring it very simply here, I assume the government pays the subsidy direct to the firms, because again, when you pay the dole to unemployed people, they go straight down to Woolworths or Walmart or whatever else and spend it. So it's effectively saying that the cash goes straight through the hands of workers to the firms, and I'm leaving out the middleman effectively in that model of the workers. And because I have constant parameters here, I'm assuming a government that holds the line against unemployment, whereas of course real world governments have gone from the situation that applied in Australia in the 1960s, where unemployment above 2% was seen as an absolute catastrophe and would lead to a government losing office, to where now 5% is seen as really good. We've got a boom. There's been a complete shift in their attitudes where they draw the line. Now again, I could include that shift too in the model if I wanted to, just by having those parameters themselves depend upon historical levels. So I use the same sort of relationship, and I say the rate of change of government spending as a percentage of GDP is a function of the level of employment. And for the what I have is government keeping the subsidy constant if unemployment equals 5%, increasing it if unemployment is greater than 5%, reducing it below that, and on we go, the same sort of exponential function. And profit is now a net of wages, interest, and the subsidy the government pays. So I put all that together, and what you get is exactly the cyclical instability that Minsky spoke about. I found this remarkable when I first simulated. I still do when I check it out. But here we have that model including government spending now. So that's each of those blocks again. I'll just dive inside one to show you the complexity. There's wages, which includes the exponential wage function. So the same complex structure I showed you could do with the racing car simulation last week. And if you take a look at the level of wages share in employment, I graph the two against each other here. Run it a bit faster than real time. And the bottom, I think, is the employment rate. The vertical is the employment, the horizontal is worker share of output. So I start with a ridiculous bubble. And then down it plunges. And if you're looking at that model, you'd expect, workers are going to go down towards 0 in terms of wages share, and unemployment stabilising at about 3%. Then this starts to happen. So you might think you're going to see breakdown occurring now because the cycle is getting larger and larger. Yep, breakdown for sure. Then it cycles back inside itself. And it'll keep on cycling forever, wrapping inside itself in that shape. I'd love to get somebody to make a three-dimensional version of this for me. Pardon? No, I mean a physical model. There are now 3D printers that actually could print this. I'd love to have a copy of it. So that is cyclical instability, the classic Minskyan sense. Government stabilising an unstable economy, not by preventing cycles, but by keeping cycles within bounds and stopping total breakdown from occurring. So you can get the essentials for the financial instability hypothesis using dynamic modelling. Can't get the nuances, you've got to have evolutionary change to talk about those. And you can bring in other elements like prices, as I'll do in the next lecture. And that then shows you what Fisher talked about when you have falling prices increasing the real debt burden and making the crisis worse, even though debt levels are being paid down. So to me, this sort of modelling is what economists need to do to escape from neoclassical thinking. Because in some ways, the reason Fisher and co just didn't get through to economists is they couldn't put a mathematical model together, and a model of this nature, a mathematical model, is part of the essential rhetoric of economics. And it's also, because it's so hard to follow through verbal logic, you can make a verbal mistake like Graziani did and not know that you've done it and get totally caught up in an infinite loop of words without ever actually properly expressing your model. So to me, it's the possibility of using this modelling to illustrate the verbal thinking that economists have gone in with, and of course, in some cases, find things they weren't actually aware of at the time. So next week, I'll go into this in more detail, but having this as a background is why I saw the global financial crisis coming. I developed that previous model I've just shown you back into my PhD thesis, and my intention has always been to write a book-length treatment of it, which is titled Finance and Economic Breakdown, and the long-suffering Edward Elgar and Sandy are still waiting for it a decade after I promised to deliver it, because I wrote Debunking Economics, which I thought would take me 6 months, took 1.5 years, back in 2001, and then after I wrote it, neoclassicals attacked the hell out of me over particularly chapter 4, so I spent the next 4 years fighting over it. And then in 2005, I got asked to write an expert witness case for New South Wales legal aid on a predatory lending episode. And at that stage, I returned to looking at the debt to GDP ratio, and I took one look at the ratio and thought, holy hell, there's a huge crisis coming. I've got to raise the alarm about that, and I dropped writing the book yet again. The case was called Perpetual, Trustees versus Cooks, and I presented both my opinion on the actual case and also a macroeconomic analysis. And I said that when you've got a high level of debt to income, you can have a financial crisis. That was the ratio of debt to GDP in Australia from, I can look at the dates there, 1950 through to 2005 when I wrote the report. And that was the level of housing debt. And I said there's a housing bubble as well at the same time, and illustrated the models I've shown you today with cycles leading to a breakdown. And then after that, I began doing all the public media work I've been doing for the last almost 6 years now, and putting out a regular report on debt, starting with one in November 2006, and finally going across to the blog, which that was the first post. I just thought I'd use it to distribute the newsletter. I now have 50 to 75,000 unique readers a month, 13,000 subscribers, well over 2,000 using RSS feeds. So it's exhausting the hell out of me to keep on maintaining that. But the main message is still the dangers of debt deflation. And I'll talk about those in detail next week.